Welcome to TheoTrade. This is Don Kaufman. It's February 26, 2018. Tonight, we shall keep it short and sweet as I am on the road in New York City right now. First and foremost, the S&Ps are up an astounding 32 handles in today's trading session. However, some fairly light volume in today's trading session. And the reason I say this is a fairly astounding move is if you start to zero in on what the marketplace expected this week, we were looking about just over a $43 expected move throughout the course of the entire week. Well, the SPX has actually got 32 of those dollars today. It would not surprise me whatsoever, and I want to be very clear about this, to actually see a breach of what was expected to the upside. And as I zoom in on this, I want to show you the upper end of the expected move this week is just about 2790. If we're going to go to 2790, we may even clip very easily back to the 2800 level inside of the SPX. Now, for those of you that have tuned in kind of day in and day out, I'm still looking for volatility to very much return to this marketplace. However, we've seen, what appears to be nothing but upside. Again, I keep saying, this just feels like you're getting baited in and baited in. And one of the indications I have tendency to look at on a day-to-day basis is a number of the volatility products. And I'll reiterate again, in today's wild upside activity, okay, and we'll use the VIX today specifically, but today the VIX is backing off a little bit, but nothing big. And I'm really bothered by this kind of, lack, if you will. There's no volatility crush really happening with the S&Ps, okay, and specifically the Nasdaq. Again, another 100-point day in the Nasdaq. They're exploding to the upside, and there's only a mild contraction, if you will, of some of the volatility. And if you take a look at the volatility futures, and again, for those of you that do tune in from time to time, you'll know I look extensively at vol futures. The vol futures are still fairly flat. And what that means is effectively the risk right now is pricing in almost the same as the risk 51 days out. So trade right now, and by the way, this is not me, I'm just reading what the order flow says on the screen. Trade right now is saying we don't know if right now is as risky as the future, is as risky as even far into the future. They're actually pricing risk flat across the entire spectrum, which is highly unusual given the fact that we've seen such substantial rallies. As I said, we'll keep it short and sweet tonight, but there's one positive aspect of this rally, and I'm going to go over to the spiders to kind of delineate some of this. Well, two things I want to show you in the spiders. Number one, if you're unaware, the spiders, they have now listed Monday, Wednesday, and Friday expiration. So, yeah, now there's a Monday expiration in the spiders as well. You have to love it. If there weren't enough expirations, we're just going to add some more expirations. But as I said, there's kind of a positive side to this kind of wild upside movement because volatility is coming down to a degree. And I'll tell you one of the positive sides of this. If you are long the marketplace, that means if you own stock, if you own a 401k, you got an IRA and you're long stock out there, you are starting to get this ability to be able to get your hedges back on. It's close. If volatility were to come down just a little bit, in the next, if you will, day or two, I think you'll be able to do trades like risk twist spreads and the atomic hedge pretty effectively. And again, for those of you that have no idea what the risk twist spread or the atomic hedge is, well, right now I'm going to show you what the risk twist happens to be. So, all right, the risk twist spread is a three-legged beast onto which I'm about to build. And I'm going to come down here to the 272s, and yes, we are 109 days into the future, well, because this trade's about volatility, it's about a hedge, or it's a huge downside play. But I'm going to sell the 272s, okay? Then I'm going to come about $10 further out of the money, and I'm going to buy 1, 2, 3 of the 262s, and I'm going to turn around and sell the 260s against it. Now, this is a risk twist spread being done for just over like a $2 debit. Listen, I don't love the price, but we're getting there. We're getting somewhere. This thing starts to drop under, okay, $2, And I think we've got a market that we can deal with and a market that we'd be able to place this trade in. So this is my risk to a spread. I can come over here and I'm actually going to, we're going to analyze the trade. And if you've never seen one of these things before, it is, again, quite the little beast to take a look at in terms of a risk graph. And again, we're just going to look out into the future. And what all I'm trying to do is trying to zoom you in and do what's called day stepping. Okay, what this strategy in effect does is it provides you this immense, okay, either downside hedge to a 401k, or it provides you this incredible upside opportunity if the market were to fall. Now, given the fact some of the volatility we've seen lately, okay, everybody wants to get the risk to a spread back on. But the problem is that volatility has still been too high. Well, with the volatility just slightly coming off in the last couple of days, again, we're really close to being able to place an effective risk to a spread. And for those of you looking to do the atomic hedge, and these are all hedging kite type strategies or strategies designed to take advantage of pretty spectacular down moves. And again, just to put a little perspective around this strategy, I mean, you're like, oh, well, you know, the market could fall. Like, look at this. This is a 1 by 3 by 1. It's a 1 unit trade that if the S&Ps fall, okay, all the way down to 250. By the way, they were down to 250 just what, 2-3 weeks ago. The trade makes about $1,000 on a one lot, and that doesn't even include the possibility of a bump up in volatility. And when you start bumping up volatility, and let's say we move vol up again by about 10 full points, this thing absolutely erupts in terms of profitability. You know, a move back down to 250, you're looking at what? About a $1,500 profitability window. And that's precisely what we just saw, again, just a few weeks ago. So take the good with the bad. I still continue to look for volatility and substantial volatility in the very near term. And what that means is not necessarily that the market's just going to fall. I think you're going to see some wild two-way action in the marketplace. So take this move today with a bit of a grain of salt over here. We're up 32 handles in the S&P, but recognize we are still in a fairly fluid situation. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye bye.